Welcome to the TIQ YouTube Trading Education Series. Today we're looking at trading profit secrets and how to give back less to the market with adjustable trail stops. It's Mike Smith, CEO. Delighted to have you here. The problem many traders face when there's a fast move in a trade that they're in, which gives them a chance to make profit, is they end up giving too much back to the market. We've got a couple of solutions in this session, which hopefully will help you remedy that. We all know the potential benefits of trail stop approaches in minimizing profit risk, i.e., the amount we give back to the market in a successful trade. But these tend to be standardized and don't reflect changes in the velocity of the price action. A common standard trail method is to use a price EMA cross, and we'll show you an example of that in a moment. In essence, the outcomes I want for you for this particular session is to consider the two approaches we're going to discuss and explore what would have happened to trades that you have taken in the past and give you some evidence to justify a potential forward test. So let's look at those two approaches. If the price move is steady and gently climbing upwards, then this is not an issue for you. But if we see an increase in price speed, we can adjust our trail to give less back to the market through two methods. First of all, tightening of our MA trail, and secondly, by tightening the time frame. For either approach, you need a trigger and an action, and we're going to talk about those in a moment. Let's have a look at these two approaches in action. Okay, let's look at a GB pound Aussie 30-minute chart. And so you can see here, this was a potential breakout trade on this candle here where it closed above this 193.35 level. So let's say we set a stop here at around about 193.17, so around about an 18 pip difference. Okay, so that's important to note. What would have happened if we'd used the 20 EMA? Well, we would have been in on this candle and we would have been triggered with a trail stop at 57 pips profit. Now, the problem is at its height, we could have actually made 111 pips profit, almost double that which we actually ended up making. So we've given quite a lot back to the market. So what we can do is we can use this risk level or an ATR to act as a trigger to tighten this trail stop up. So let's say we took the level, if it's over 2 times our risk level, so in this case, that would be 2 times 18 or 36 pips, then we're going to trail it up. So at this stage, at this candle close, you can see there, it's easily over that 2 times risk level. So what we can do at that point is just alter that from a 20 to a 10, and you can see it's brought the risk level down again. So in this case, we end up making 74 pips profit rather than 57. So a significant difference in terms of our outcome from this. Now, the other way we can do this, the second approach, is rather than altering the MA, we alter the time frame and make it a faster time frame. So if we go to a 15-minute chart, you can see the blue line there. There's where we entered the trade on this one here. And you can see here, we're still using the 20 EMA. We've just altered the time frame and we've made 72 pips profit rather than that original 57. So either of those two methods is acceptable. Remember, you've got to have a trigger. And in this case, we specified a trigger of twice our risk level and utilized our two approaches accordingly. And you could, even when going to a faster time frame, go again. So if we see here, the distance between this candle and this adjusted risk level is 52 pips again. So again, way more than our 2 times risk level. So what we can do even on the faster time frame is do exactly the same. And we'll tighten it up. And there you see it would have been triggered if it was a touch at this point here, making a profit of, again, around about 72 pips. So 2 approaches. You either move to a faster time frame, or in the first example we showed, we decrease the EMA trail to a lesser level. So in this case, we use 20 down to 10 EMA. So tightening the EMA trail or tightening the time frame either need a trigger. For in this case, we use twice our risk level, but you could easily use twice the ATR or similar, whatever fits for you in your testing and subsequently trading. And then we need the action we're going to take. Either we tighten the MA trail or we tighten the time frame accordingly. Now, the risks associated with this is because we're essentially tightening the trail, we do risk potentially being triggered early too. So we've just put another line on here at the point of trigger. Now, if we go to the 5-minute chart, you'll see that would have been the point at which we adjusted our trail, and we would actually get taken out at this point here, which would mean we would only get 52 pips. So there is a risk that through tightening a trail, then you can subsequently get triggered early. So that's the risk you need to be aware of. And in your testing of this to see if it could be a trading approach that you can take, then of course it's something that you need to go back and have a look at for yourself. Now, of course, we haven't even covered whether we use a price MA touch or a price MA close, because if we just used a price MA close, we would have actually done very well out of this, and we would have been in this trade for our 77 pips. So that's another discussion for another video. But at this stage, what I want you to focus on is the two approaches we've been talking about today. So your potential system, just to reinforce current price, for example, more than 2 risk level or more than 2 ATR. And your response is either to shorten the MA, for example, for 15 to 10 or 20 to 10 in the example we used, or shorten the time frame. Now, the variation, if it's over 4 hourly, because the gap from 4 hourly to 1 hourly is quite a significant difference, then in that case, if you're using 4 hourly as your standard entry or even daily, you would probably choose the shorten MA approach. Just one final note, never ever adjust back if the price action doesn't go your way after you've taken action. That's the same essentially as moving a stop away from price just to stay in a trade. Not good trading practice and something we would never recommend. So in terms of your actions from this session, first of all, test the approaches discussed and explore the what would have happened if on trades that you've already taken. It's always better to do that rather than just do a series of random backtests, because you should obviously have the data available. Secondly, of course, if you choose to move forward with this as a concept, whichever you choose should be written in your trading plan. Thank you very much for your attention. It's been a pleasure to have you along for today's session. And of course, if you would do me the honor of liking the video and subscribing to the channel, we will be eternally grateful, and it will give you the ability to access easily future videos. Thank you. Trade safe. We'll see you again soon. Bye bye for now.